Hey everyone, me Kevin here. This summary of a 100-page Morgan Stanley report is excellent to give you another perspective as to what could actually be going on in the economy over the next 2 to 3 years under the Trump administration. Now keep in mind, this is Morgan Stanley's opinion, so it could be wrong. Everybody's got a guess as to what's going on, but I'll give you my opinions on it as we go through it. So it's called a year ahead outlook recap. So it's a recap of their 100-page report, and we're going to go through just the recap here. So over the next 2 years under Donald Trump, Morgan Stanley expects lower immigration and more tariffs, both of those, mind you, to slow GDP growth and make inflation stickier. Now, let's explain that quickly. When you have fewer people, you have fewer people who are buying goods and services, and that's a simple way to explain a GDP argument. Businesses could potentially also become less productive if they have less immigrant workers. Now, this is not an argument here to say whether illegal or legal immigration is good or bad. I'm an immigrant. I came here with a green card and a visa and then a green card and then a citizen, right? So there are legal ways and then there are broken other ways to come into the country. But the point of this is, the fewer people you have and the less unemployment growth you have, or rather the less employment growth you have, the less your GDP tends to grow. So Morgan Stanley sees slower growth here. Now, it has been a pretty common argument to argue that because you'll have less productive workforces, you'll see some Trump inflation. And when you combine that with tariffs, yeah, it makes sense. And it's one of the reasons why the bond market has been so expensive in terms of yields. And yields have been relatively high, 4.5% to 5% range here on the 10-year, for example. The 1 year is even higher. It's crazy. We're about to invert again on the 2s, 10s. Crazy, which is a recessionary signal. But both of these things are signals that are bearish, right? Higher inflation means potentially higher interest rates at the Fed. Slower GDP growth means you're towing closer to that recessionary line. Inflationary pressures and policy uncertainty spark greater Fed caution, leading to a pause in the second quarter. Boy, that would be such a mistake. That would just be the nail in the coffin for the stock, or frankly, the U.S. economy, eventually the stock market. Sometimes the stock market can actually lead a poopy-doopy recession. And usually the stock market bottoms about 6 months before the end of a recession. Well, given that the downtrend in the stock market hasn't happened yet, it's likely we're not in a recession at this very moment, unless you want to just say the whole last 3 years have been, which is also unlikely given unemployment growth. But more and more it is looking like we are trending towards a larger slowdown. And Morgan Stanley, though, they don't think it's going to happen as fast as other people think. I keep thinking 25. Morgan Stanley has a different opinion. They think there'll be a pause in Q2 25, and they'll actually pause for 1 year, a 1 year pause, and they'll resume rate cuts in the second half of 2026. That actually could be more than a 1 year pause. That could be a 1 to 1.5 year pause as higher tariffs hit growth and job gains almost stop. So they basically think the jobs market is going to just hit a wall. So for the 2025 season and 2026, overall they forecast real GDP growth to slow from 2.4% this year to 1.9 in 25 and 1.3 in 26. They think that immigration bolstered supply, allowing for this rapidly growing economy and falling inflation. Net immigration was around 3.3 million in 23 and accounted for about 85% of population growth. In other words, we're having fewer babies, we're just letting more people come into the country. We expect immigration only slightly below that in 2024, but assume new policies will dramatically decrease immigration flows by the second quarter of 2025. Tariffs are also stagflationary. They're a tax, and while many of the imports under tariff will be consumer goods, many will also be intermediate goods used in domestic manufacturing. In other words, as we expect a gradual increase in tariffs through the end of 25 and beginning of 2026, they actually see oopsie-doopsies coming in the way of inflation sticking around longer. And so what I'm actually planning on doing, and let me know in the comments if you're interested in this, is I'm putting together something that I'm calling the Trumponomics plan. And it's basically going to be your guidebook for what you need to do in 2024 and what you need to do throughout 2025 from a tax point of view: stocks, real estate, bonds, commodities, crypto. Every single thing in every tax loophole we could potentially think of, we're putting it together. So that way we can help you and then update those as Trump policies come out. So stay tuned for that. But anyway, take a look at this. Meanwhile, there is a negligible fiscal offset, in other words, stimulative offset, right? The majority of fiscal policy is expected to be an extension of the Tax Cut and Jobs Act, as some of those provisions start expiring in 2025 at the end of 25, beginning of 2026. So we'll probably see a little fiscal support here. So basically they're saying tariffs are stagflationary and they hurt GDP. Less immigration hurts GDP and is potentially inflationary. So where does this leave us? Both slower immigration and tariffs dampen disinflation relative to a prior forecast. Slower immigration and a tighter labor market push up services inflation, but a relatively flat Phillips curve means that lower unemployment rates moderate the effect. So in other words, maybe it'll just be a slowdown and softish landing, but not sort of a boom. Take a look at this. On the labor side, payroll growth is expected to fall to 113,000 per month on average in 2025. The unemployment rate isn't actually expected to go up that much, though, because there'll just be fewer people in the workforce. So it'll seem like at the same time as more people are unemployed, the workforce is also shrinking, so the percentage is lower. Kind of weird how they pull that off. But anyway, they see consumer spending growth weakening thanks to lower immigration, right? Fewer people buying things, and the restraint from high interest rates taking more of a bite at the end of 2025. Despite the drag caused by policy shifts, business investment will remain strong in 2025, fueled by artificial intelligence. Go super micro, let's go. Keep in mind, if you haven't yet seen it, my alpha reports have been calling out the nonsense of the super micro pain. Initially, I was part of the, oh no, this is really bad. But then once I actually did some fundamental research, I started talking about this in the course member live streams and the alpha report. I'm like, I don't know, man. This valuation's gotten pretty low, and that stock's just been absolutely on a tear and killing it. Hopefully it keeps going. And also, in case you didn't see my other video on the Trump Press Act, I did want to apologize to those of you that tried signing up over at robohack.ai for the venture capital due diligence we're doing on a robotics investment and multiple other VC investments that I know many of you want to be a part of. So many of us signed up that we crashed the DocuSign and they locked our account because they thought we were spam. So we're working to resolve that. If you email us, though, go to robohack.ai. You'll see the email there. It's invest@robohack.ai. We could give you the link manually until we get that all resolved. Oops. Thank you, though, for the support. But anyway, investment slows in 2026 with tariffs, though we still see it running above GDP growth. So they're still bullish on AI and AI investment. They're bullish on really just the economy staying out of a recession, which is good. But they do think things are going to really slow down in 25 and 6. I personally am of the mindset that all it's really going to take to actually induce a real recession is some kind of shock that tanks the stock market. Like, as an example, I'm not saying I think this is going to happen, but as an example of what could do it, Bitcoin hits $102,000, maybe it even extends a bit to 105, 110. Then all of a sudden there's some kind of crypto crash, crypto winter or whatever, and I don't know, the sucker goes down to 70K and MicroStrategy collapses, by 50, 60, 70% or whatever, and we start running into debt issues. That turns into some sort of risk-off momentum, which hits companies. Companies are like, oh no, our stock is down, let's lay people off. And it really just accelerates you into a recession. I don't think you could really bet on that. I think you could hedge for that, but I don't think you really bet on that because things usually take a lot longer than you suspect. TLT 2027, anyone? But anyway, against this backdrop, we expect a slightly higher terminal rate in 2025, but more cuts in 2026 due to lower growth. Higher inflation in 2025 will keep the Fed more likely to pause. Morgan Stanley does see 25 basis point cuts at the next 4 meetings. It's not what the market sees right now. Market sees 50-50 chance of December and like a 25% chance that you get 2 cuts back-to-back, December and January. So we'll see what the next data says, I suppose. But and then we got minutes coming out next week as well. So we'll be covering those on Tuesday. That'll be entertaining. But anyway, tight immigration policy and deportations imply lower potential GDP or productive capacity. So the Fed must restrict demand to conform to lower levels of supply. So if now you have restricted manufacturing, they don't want too much demand because that's inflationary, so you restrict demand, which is what the Fed can do, and then they go, oh yeah, we're going to have rates. Oh, that's a weird little reaction there. Then we're going to have rates higher as manufacturing is in the poopers, which the last PMI report wasn't that particularly fantastic either. When we were going through the PMI report, we definitely saw some weakening in manufacturing that had been some of the worst that we'd seen in a while. Anyway, thank you so much for watching. If you want to see where I am on vacation or see some clips or whatever, make sure to follow me at Meet Kevin on Instagram. Check my stories and Real Meet Kevin on X. Thanks so much, and we'll see you in the next one. Goodbye and good luck.